Markets don't always warn loudly before something changes. Sometimes, the warning is quiet. And right now, that warning is coming from the one place that usually tells the truth, the bond market. Throughout 2024 and 2025, global markets showed incredible resilience. We saw a pandemic-fueled default wave clear out weaker players, leaving behind a market that felt invincible. But beneath the surface, a specific signal has been flashing. It's called spread compression, and it defines the moment when investors stop fearing risk. By late 2025, investment-grade corporate bond spreads tightened to just 74 basis points. That is the tightest gap we've seen in 15 years. To understand the scale of this confidence, gross bond supply hit $433 billion in the third quarter alone. The market absorbed it all without blinking. Think about what that means. Investors are accepting historically low compensation to lend money to corporations. The risk premium has evaporated. Why? Look at the yield to worst. It sat at 4.81% in September. Investors saw that number, compared it to cash, and piled in. It's the classic reach for yield. With government rates stabilizing, the easy money in cash is gone. So capital is forced to move. It flows from safe treasuries into corporate debt, and from corporate debt into high-yield junk bonds. In 2025 alone, high-yield bonds returned over 8.6%, a massive number for a safe asset class. This flood of cheap money wakes up the animal spirits. We're seeing a resurgence in mergers and acquisitions, fueled by deregulation. But there's a catch. Highly leveraged deals, buyouts, takeovers, add debt to the system exactly when protection is cheapest. Analysts at BlackRock pointed out a critical danger. Recession risk is absent from current pricing. The market is priced for perfection. JP Morgan analysts have already warned that junk bond spreads are biased wider for 2026 due to macro uncertainty. But the market isn't listening yet. We saw a glimpse of this fragility in early 2025. When new tariffs were announced, spreads widened instantly. The calm can break in a single morning. This is what we call the complacency trap. It's not that the economy is bad. It's that the buffer for bad news is gone. Foreign investors poured over $90 billion into U.S. corporate debt in just 3 months last year. Everyone is crowded into the same trade. And when everyone is on the same side of the boat, even a small wave can cause a capsize. History rhymes. In 2007, spreads were also historically tight right before the GFC. Low volatility often precedes high volatility. We are facing a new conundrum. Rate cuts might come, but long-term yields could rise anyway due to deficits and trade wars. So, the signal is clear. The market is taking maximum risk for minimum pay. Optimism is high, but resilience is lower than it looks. In Part 2, we'll break down exactly what happens when this sentiment shifts and how you can protect your portfolio from the fallout. In Part 1, we saw the signals: tight spreads, high leverage, and a market priced for perfection. Now, in Part 2, we ask the hard question: what happens when the music stops? Financial markets are driven by expectations, not reality. And right now, expectations are set to flawless. But history shows us that when sentiment shifts, it doesn't happen gradually. It happens all at once. The first casualty is liquidity. When fear returns, the buyers for those high-yield bonds disappear. Prices don't just dip, they gap down. You want to sell, but there is no one to buy? This is why corrections feel so sudden. Prices adjust faster than fundamentals. The risk isn't today's optimism, it's the velocity of the reversal. So what does this mean for you? This environment requires extreme discipline. It doesn't mean panic selling everything. It means understanding what you actually own. Are you holding high-yield corporate debt thinking it's as safe as cash? Are you overexposed to sectors reliant on cheap refinancing? Now is the time to audit your risk. Remember, markets reward patience more than prediction. The goal isn't to time the exact top. It's to ensure you can survive the drop. Rising risk appetite is a classic late-cycle signal. It reflects trust in central banks and a belief in eternal stability. These forces can persist until they don't. When trust breaks, it breaks fast. The new conundrum of falling rates but rising yields could challenge every portfolio model we use. Right now, investors are taking more risk quietly, not out of fear, but out of confidence. History suggests this moment matters. Because in finance, the biggest changes always begin exactly when everyone feels comfortable.